Hey everyone, welcome back to Corporate Decoder. Today we're diving into Cathay General Bancorp's latest quarterly report. Let's see if their numbers are as impressive as their Nasdaq ticker symbol, Cathay. We'll decode the details and see if this company is really sitting pretty or if there are some hidden worries we should be aware of. But before we jump in, if you're into understanding what these companies are doing with the numbers, make sure you hit that subscribe button. Also, come join our Discord. Links in the description where we go through these reports together. Okay. First things first, this is their report for the quarter ending March 31, 2025. It's like their financial checkup for the last 3 months, and we're here to understand what happened. As of April 30, 2025, they had around 70 million shares of their stock out there in the world. This number is important because it tells you who owns the company and how earnings are split up. The company's most recent report includes information about the financial health of the company, including numbers from the balance sheets, income statements, and cash flow statements. Let's quickly take a look at the most recent balance sheet. The balance sheet is a snapshot of what the company owns and what it owes as of a specific date. As of March 31, 2T, $22 billion, that's a lot of money. But what makes up that huge number? A big chunk of that, almost $19.2 billion, is in loans. This makes sense since Cathay General Bancorp operates Cathay Bank, and banks make money by lending it out. On the other side, their liabilities, what they owe to others, totaled roughly $23 billion. Most of this is in deposits. That means money people like you and I have put in the bank, $19.8 billion to be exact. A good sign there. Deposits are slightly up, showing good customer trust. Next up, the statements of operations. That's basically a report card of how the company made its money. For the 3 months ended March 31, 2025, Cathay General Bancorp had net income of about $69.5 million. That's a profit, which is always good. This profit comes from interest and dividend income, so mostly from the interest they get on loans and investments. In fact, that number is about $319 million. But it costs money to make money, and their interest expense, what they pay out, was almost $143 million. That's a profit, which is always good. This profit comes from interest and dividend income, so mostly from the interest they get on loans and investments. In fact, that number is about $390 million, and their interest expense, what they pay out, was almost $143 million. That's a get on loans and investments. In fact, that number is about $31 million, and their interest expense, what they pay out, was almost $143 million. So they had to subtract that amount. Now, drilling down on this report further, we can see some major items changed in the last year. The net income for this last quarter was $69.5 million versus $71.4 million last year. That looks like the trend is negative, even though the market thinks banking is doing well. What is interesting is to look at line items relating to income and what is impacting that. One thing that did change is what they had to put aside from their profits due to potential credit losses. These credit provisions went up a whopping 15s get tough. Another interesting thing to note is that salaries and employee benefits expense remained roughly unchanged from $43.6 million last year to only $42.4 million this year, which indicates the companies has not added too many extra people to their payroll. Moving on, let's consider comprehensive income, which gives us a more complete financial picture than just net income, because it also includes things like unrealized gains and losses on certain investments. Total comprehensive income increased from $64.6 million to $83.4 million. But you shouldn't get excited since that increase is coming from net holding gains on available for sale securities, which means gains on bonds they have, which depends a lot on interest rate fluctuations. This increase may be a signal for how well managed the company is, but also just as likely something in the accounting that you'll never realize. Next up, the company had stock changes driven by its dividend reinvestment plan, restricted stock units, and treasury stock repurchases. They bought back a good chunk of shares and are sending a signal that the stock is a good value for them to reacquire. Okay, now what about cash flow? This section tells us how much cash the company is bringing in and sending out from its regular business activities. For this quarter, they made $99 million in cash, higher than the same time last year. However, their net increase in loans means they may have difficulty loaning to creditworthy people. They are, however, investing in more available for sale securities, showing that they are still profitable and reinvesting extra cash flow. This may not be enough high quality customers to be loaning to. Lastly, they had to pay back much of their cash borrowings with other banks. It could signal they didn't need this cash. Ultimately, their cash reserves ended up growing a good amount, $345 million to be exact, now being worth about $1.38 billion. Now, let's transition into what accounting rules they will have to follow. For example, they will have to provide much more detail on their income statement expenses soon. There are also updates to how income taxes are disclosed that will be effective for them in 2025. A lot of the cash ends up sitting at the Fed for those interested. This helps meet compliance standards. What's interesting here is that we can see the equity grants granted to the executives. I always recommend paying attention to the equity grants and terms that management gets. Andrew as of March 31, 2025, old of 25. Diving into investment securities, they break down the types of bonds and securities held, the gains and losses in those. AFS is similar to held for sale in that the company expects to sell, but is not in any way certain about if they will. This section also details the maturities of their bond, and most are due after 10 years. These bonds are sensitive to the market, so there may be potential ups and downs, but they have made a financial decision to invest into long-term yields. For a detailed explanation, they go over loan risk and expectations of write-offs. Loans is the meat of the business and is the key element to study. What is interesting is that they are making more money on residential real estate loans, but commercial is what makes them a ton of money. Also, with almost identical rates, it's interesting how big of a component real estate makes up of the assets. Next, for real estate, most are in California, so there may be a location-related business risk in case the California markets go down. Also, many loans do not have any allocated loss. This means they consider these to be as good as money. I wonder if these are accurate and whether the company will have to reclassify soon. This quarter, the company finished its buyback and repurchased almost 1 million shares. This makes me very happy, as a stock buyback is a great signal for the company that it has faith it will keep growing. This increases earnings per share. The company also outlined its biggest risks. This section doesn't seem to contain any new updates from its last filing. The details will be important to study carefully, especially the sections discussing tariffs, data system failures, and the soundness of other financial institutions. Lastly, for a lot of the people that really get into this, the company shares all the additional SEC exhibits for those to dig through. To finalize and summarize the story here are the big points. ESC.T. There was a net income, and the increase came mainly from their gains that are not really income related, and more loan defaults, specifically in the commercial industry. This is a company that needs to reevaluate its target customers. Less opportunity than they used to. There was a big increase in cash, but that may mean it's difficult finding people to loan money to. And there were more loan defaults, specifically in the commercial industry. This is a company that needs to reevaluate its target customers. That's my take. What are your thoughts? Be sure to let me know in the comments, and be sure to hit that like button and subscribe for more deep dives. I'd love to see you on the Discord, which is linked in the description. Thanks for watching. See you in the next one.